Welcome to this session. My name is Barbara Bochalia. Today we are going to look at national income accounting. Now, national income basically is the monetary value of the final goods and services that are produced within an economy or a country in a given period of time, right? Gross domestic product. Gross domestic product refers to the final value, the final monetary value, or the monetary value of final goods and services that are produced within a country's borders. Yeah, within a country's borders. So the fact that it is gross domestic means it is national income that is that is generated within the country's border, and national income is the monetary value of final goods and services produced in a country. So if it's gross domestic product, it will be the monetary value of final goods, of all final goods and services that are produced within a country's borders. Now, these final goods and services, they are basically what we would refer to as final output. For example, final output for final use. Then we have intermediate goods. These intermediate goods can be, an intermediate good is a good that can be both a final good and an input in the production process. For example, milk is an intermediate good, raw milk, right? It can be a final good, and it can also be used as an input in the production process. For example, milk can be used in the processing of yogurt, in the processing of ghee, in the processing of ice cream, right? So an intermediate good is a good that can be a final product and can also be an input in the production process. So we also have what you call value added. Value added is the difference between the final good and then at the stage. For example, we have during the production process, we have the stage where we are using the good as an input. From that stage when we are using inputs into the production process, and then that other stage when we finally have the final product. Are we together? So value added will be the difference in terms of prices. All right. For example, if we have milk, and it is supposed to be processed into yogurt, right, or into ice cream, so we get the value of the final ice cream, and then we subtract it from the value of the raw milk before it was processed into the ice cream. And so that figure we get will be the value added, right? So for example, in this perspective here, we have a table where we are seeing value added in the production of a gallon of gasoline, right? Of gasoline. Gasoline is used, it is used as fuel, right? So for example, here we shall have stages in the production process of gasoline. We have first of all, oil drilling. Yeah, at the time when it is at oil drilling, it will be, for example, $0.5. And then we go to another process of refining. The amount, it now comes to a price of $0.65. Then shipping, it comes to a price of $0.8. Then the final retail price, now it is selling $1. So we realize that the value added, of course, from one process to another, there is a value added. For example, from oil drilling to refining, we realize that the value added will be 15, that is 65 minus 50. And then from refining to shipping, we realize the value added is 0.15, that is 0.8 minus 0.65. And then from shipping to the final retail price, it is $1. So practically there, the value added from shipping to the final retail price will be 1 minus 0.8, which is 0.2. So to get the total value added, we shall add 0.15 plus 0.15 plus 0.2 to finally get 1. Yeah. So practically that's how we calculate or we determine the value added. Now, remember, we've seen that GDP is the monetary value of all final goods and services produced within a country's borders, right? So GDP excludes, all transactions. It ignores all transactions in which money or goods change hands, but in which no new goods are produced. Yeah. So GDP excludes, for example, we are going to see that why it excludes those goods and those goods that change hands, basically to avoid what we call double counting, because you may realize that, for example, if it is a building, yeah, it was constructed maybe last year, and again this year you're counting it, right? You're counting it in your national accounts, then that will be a repetition, right? So it considers, for example, if it is a real estate, houses, plant, equipment, or machinery, it considers new machines, it considers new buildings, right? To basically avoid double counting. Now, let us look at the difference between GDP and GNP. Like we've already seen that GDP, gross domestic product, and GNP is gross national product. So GDP is will be national income within a country's borders, right? And the GNP, for it will be the national income generated by all citizens of that, I mean by all, for example, if it's Ugandans, GNP will consider all nationals in Uganda and out of Uganda. Are we getting the difference? Whereas GDP, it considers national income within a country's borders. If it's Uganda, it means that GDP is considering the national income within Uganda only. That's why it is gross domestic product. Yeah, national income for the people within the country's borders. And you'll find that the people within the country's borders are not only Ugandans, but there are also people from other, maybe Ugandans, Kenyans, but as long as they are within Uganda, within the country's borders, that will be GDP. Then the GNP, it considers national income. If it is Ugandans, it will consider national income for Ugandans within Uganda as a country and the Ugandans outside Uganda. So that is GNP. So that is the difference, basically. And remember that we've seen that national income is the monetary value of final goods and services produced within a country, produced in an economy. Yeah, produced in an economy. National income is the monetary value of all final goods and services produced in an economy in a given period of time. So how do we calculate the national accounting? Remember, we are looking at national income, right? How we take those national accounts, national income, right? How do we measure this national income? We basically have three approaches in measuring national income. We have the expenditure method, or the expenditure approach, the income approach, and the product approach, or the value added approach. Those are the basic, those are the three methods that we use in measuring national income. So let's look at the expenditure approach, right? So the expenditure approach basically will measure the amount of all final goods during a given period. And within this expenditure approach, basically, it is looking at consumption, investment, government expenditure, and then net exports. Right? So with the expenditure approach, GDP will be given by C plus I plus G plus X minus M, right? Where C stands for personal consumption expenditures, I stands for gross private domestic investment, G stands for government expenditure, and the X minus M stands for net exports, In other words, net exports means export minus imports, the value we get when we subtract imports from exports. It could be a negative value or a positive value. Of course, if the exports are greater than the imports, we shall have a positive value, a positive net export value. And if the imports are greater than the exports, we shall have a negative value, which is not a good stand, which is not a good position for any economy, right? So that is the expenditure method. Now for C, which is personal consumption expenditure, here we are basically looking at household spending on consumer goods, how individuals spend on consumer goods. Then for gross private domestic investment, we are basically looking at how these farms, how business farms and households or individuals spend on new capital, new equipment, new machinery, new investment, new residential structures, for example, real estate. And that's why we've seen that that national income looks at, it considers only investment in new investments. For example, it considers investment in new plant, new equipment, new machinery, new capital. As long as it's not new, then we shall not count it, we shall not consider it when we are carrying out our national income accounts, because there it means that we shall be doing a double accounting, right? Then G stands for government expenditure or government consumption and the gross government expenditure, whereby with the government expenditure, we are going to see that the government does a number of spendings, number of investments, for example, in different sectors of the economy. So we add that amount that the government has spent, right? So it will stand for G. And then, like we've already seen, the net exports will be the exports, yeah, minus the imports, right? So there is our method for GDP, which is expenditure method, which is C plus I plus G plus net exports, right? So personal consumption expenditures, here we realize that individuals or consumers do spend on a number of goods, some of which are durable goods, some of which are non-durable goods. They also spend on services like education, medical services, legal services, right? And then for investment, Like we've already seen, it refers to purchase of new capital, purchase, investment in new inventory, investment in new residential houses or real estate, right? All right. Then another important thing for us to note is that with this investment, when we shall realize that, I think later on, that when we want to get the net, yeah, there is what we call net domestic product. I think we shall see that later. The net, that's when we shall have to subtract the depreciation. That's when we have to, if we are getting, for example, the net domestic product, we shall have to subtract the depreciation from the investment, because it is the, for example, the machinery that depreciates, yeah? So there we shall be getting the net, for example, gross domestic product or the net national product. Now, let's look at the second approach to measuring national income, and that is the income approach, right? So with the income approach, basically, we are looking at the total income that is earned by all factors of production in a country, by a country's citizens. And what are those factors of production? We know there is land, there is labor, there is capital, there is entrepreneurship, right? Those factors of production. So with the income approach, it looks at the payment to those factors of production, right? So our method for the income approach, of course, at the end of the day, it's all GDP, because you may be asking, why is it GDP? You can call it GDP, or you can call it GDI, gross domestic income, or gross domestic product. It's all the same thing, right? So our method for the income approach of measuring national income will be given by GDP being equal to compensation of employees. COE stands for compensation of employees, right? And then the P stands for corporate profit, right? There are those corporate companies, yeah? So the profit they make will be the corporate profit. And then the I stands for proprietor's income, yeah? Proprietor's income. And then the RI stands for rental income. RI stands for rental income. And the NI stands for net interest, Remember, we've seen that income approach refers to the payment to the factors of production, right? For example, realize that what is the payment to capital? The payment to capital is interest, That's why we have net interest, right? Net interest, right? And then what is the payment to, for example, labor? The payment to labor is wages, right? Of course, here we shall be looking at salaries of employees, right? Plus, for example, here in Uganda, they are national social security contributions. So this is labor, right? The interest is for capital, right? And then the employees, right? Proprietors' income, yeah? We have entrepreneurs, yeah? So the entrepreneurs also corporate profit, right? Profit is a payment for what? Yes? Yes, Jonah? Yes, Jonah? Hello?
Profit is a payment to investment, one investment.
Run
Capital,
investment.
rather.
What?
Capital, rather. Capital.
I thought interest is the payment to capital. And what's the payment to entrepreneurship? Profit, isn't
Profit,
it?
yeah.
Yes.
Yeah.
So that's why we have,
then wage
yes,
is labor, right?
yes. So that's why we have corporate profit. Are you getting? Corporate profit for entrepreneurship. Then net interest for capital. And then compensation of employees, there we see wages, isn't it? Because it's the laborers that get the wages. And land?
Land is rent.
Yeah, that's why we have rental income. Are you getting the logic?
I do.
Yeah, so like we've already seen that the income approach looks at the payment to all factors of production in by countries, citizens. Yeah, so that is the logic behind that. We are getting the payments to all the factors of production within a country. For example, within Uganda. And then those payments, we shall add them all to get the final value, which we call the gross domestic income or the gross domestic product, because it's all national income. So if you feel like you've forgotten the method, you just go back and get the logic, and you're like, what are the factors of production? What are their payments? There, it will be easier for you. Now, the compensation of employees, I've already talked briefly about them. Compensation of employees, it will be the remuneration of employees for work done, yeah, which will basically include the wages, the salaries, the contributions to the, for example, NSSF here, right, and other programs. And then the corporate profit will be the surplus due to owners of business environment. Of course, we know that profit is payment to entrepreneurship. And then proprietors' income, yeah, we know that proprietors are entrepreneurs, isn't it? Yeah, a proprietor. Yeah, someone who pioneers a business. Yeah, so for proprietors, it will be for unincorporated businesses. Yeah, so we know that there are corporate types of businesses. You have corporate businesses, yeah, and you have those ones that are unincorporated. Those ones that are corporate, they're those ones that are legal, that are legal entities, isn't it? Right. So we get all that profit now, proprietors' income, and then corporate profit. So that is the logic behind. So we now see that this is the circular flow. This is the simple circular flow of income, where we see that this circular flow basically involves movement of factors of production between different sectors of the economy. For example, here it is a simple circular flow where we have business firms and the households. Households are individual consumers, yeah? So we have that, we see these factors of production. For example, we realize that households provide these factors of production of labor, land, capital, entrepreneurial activities to business firms. For example, you may find these individuals, they are providing labor. They are working in these business firms, so they are providing labor, right? They can sell land to these business firms, that kind of thing, right? They can also maybe lend out money to these business firms. And then in return to the payment of these factors of production, of course, respectively, we shall see that in return, for example, if the households are providing labor, they are working within this for these firms, these firms will pay them wages in return as payment for working for them. If, for example, they offered maybe their premises for these business firms to use, then they will pay, the business firms will pay rent. Yeah. If, for example, they offered maybe loans, they lent out money to the business firm, the business will pay interest, isn't it? And then the profits, of course, if the households are provided entrepreneurial activity, someone starting up a business, then at the end of the day, they will be getting profits. So we see that this is a simple circular flow of income, basically, that helps us actually to know how the income approach works, for the payment to the 4 factors of production, right? And then we have the final method, the last method, which is the product approach. the product approach of measuring national income, or what we call the value added approach. Now, with the value added approach, like I think we've already seen, we saw what value added means. With value added, basically we are getting the difference between total sales minus the intermediate goods, right? Right? So with the value added, gross value added, we are getting the total sales of a good, which is total output, minus the purchase of intermediate good to produce the goods sold. We saw an example, which was for example, I think you came in a little later, but we looked at what an intermediate good is. An intermediate good is a good that can be a final good, and it can also be used as an input in the production process. For example, milk. Milk is an intermediate good, right? It can be sold as a final good, raw milk, right? Can be sold as a final good when it's raw milk, but also it can be used as an input in the production process. For example, we can use this milk to process, for example, ice cream. You can use it to process ice cream. You can use it to process what else? Ice cream, maybe yogurt, right? Yogurt, ghee, and all those other milk products. So it can be an intermediate good, can be a final good, but it can also be an input in the production process. So with the value added or the product approach, basically, it considers this formula of subtracting the total sales of total output minus the purchase of intermediate good, basically to avoid what you call double counting. Yeah. For example, if it is ice cream, right? Ice cream, and you count the amount sold for the total ice cream in the country, and then you count the amount sold for the what? For raw milk, for raw milk in the country. That will be a repetition. That one will be a repetition. Why? Because you use milk as a raw material to process ice cream. So if you count the monetary value for milk and the monetary value for ice cream, that one will be double counting, because milk is an input in the production process to produce ice cream. So the best thing to do is only to count the final value of ice cream, right? For example, if the milk was, let me say, 1,000, I'm just giving an example. If the cost of that milk was 1,000 Ugandan shillings, and this milk is used to process ice cream, and the final value of that ice cream is, for example, 3,000 shillings. 3,000 shillings. It means that the value added is going to be the difference between the final value of ice cream, which is 3,000, minus the value of the intermediate good, which is milk, to give us the value added as 2,000. Are we getting the logic? Instead of counting the value of milk, which is 1,000, and the value for the ice cream, and then you get 4,000, that will be double counting. So that's the essence now of the product approach, or the value added approach. So all these methods, they allow us to get the final, they should be, actually the expenditure method now is the one that combines all these methods. It combines all these other methods, right? So someone would be asking, why do we use now all those different methods? Why don't we use one method? We realize that now each method is applicable to each sector, has an appropriate method of measuring income, right? For example, the product approach is very suitable for the primary sector, such as the agricultural sector, the industries. Are we getting, right? The product approach is appropriate, is used basically for the primary sector, which is the industrial sector, the agriculture sector, the industrial sector. For example, we realize that most of these agro-based industries, yeah, they use agricultural products. Yeah, I've given an example of milk, right? Milk, when it's processed, at the end of the day, you will not, you have to avoid the double counting, yeah, like that the example I've given of milk and ice cream, right? And then of course agriculture and then industries, because these industries transform the input into the final good, and we've seen that the value added basically will be the difference between the final good, the price of the final good, and the price of that good when it was at that stage of when it was actually an input in the production process. So the value added basically would be that amount. For example, from milk to ice cream, what is that value added? It will be the difference between the price of the two, right? So the value added approach or the product approach is for the primary sector. And then we have the income approach. The income approach basically is for the services. Tertiary is the same as service sector, is for the services sector, right? The services sector, where we are looking at, for example, we looked at rental income, right? Rental income, they're providing rental services, yeah? We looked at these people are, for example, we looked at these workers that are working for the government. Yeah? They are providing a service to the government. They are working for the government. So we are looking at their income and then with the income approach, and then we come up with the final value of the national income, right? And then like the expenditure approach is only for calculating the identical relationship. In other words, the income approach and the product approach avail us with the information that we use for the expenditure approach. So they all work together. You cannot say that you are using only a single method. So that is how the national income for countries is measured. That's those are the yardsticks, or that is those are the methods that they basically use to come up with those national income accounts. Then the net national product, right? Whenever you see the word net, it means there is a gross figure that there is something they are subtracting from a gross figure, right? So with the net national product, we've already seen that, can you remind me, what did we say gross national product is? Gross national product.
Gross national product is the total incomes of both nationals within the country and
the total of what?
Total income or total product of nationals in the countries and the national and those outside the countries.
Yes, total national income.
The total net
of which
product.
we saw the total national income is the monetary value of all final goods and services that are produced by nationals in that country, in that country's border, as well as nationals elsewhere. For example, in the diaspora, Uganda, if there are Ugandans, there will be Ugandans in Uganda and Ugandans in the diaspora. Yes. But now the challenge with the gross national product is that it's difficult to measure that national income by Ugandans, for example, in the diaspora. How will you measure? How will you know all the Ugandans around the world? So that's why at the end of the day, we end up with gross domestic product. And actually, when they are measuring economic growth, they use gross GDP figures, gross domestic product, because for it is easy to measure. You're considering the national income within a country's borders, right? Now, when we say net national product, it means you are getting the gross national product minus the depreciation. Minus the depreciation, right? So basically here, yes?
How are we determining the depreciation? How are we determining the depreciation?
The depreciation. I talked about that. I explained that when we are using this this expenditure approach, where we say that income, Y stands for income, for simplicity. The expenditure approach, where we say that income or GDP is equal to C plus I plus of course consumption plus investment plus government expenditure plus the net exports, which is X minus M, exports minus imports. So the depreciation is subtracted from the investment. Yeah, the depreciation is subtracted from only the investment. Why? Because we've seen that, for example, you can invest in machinery, isn't it? New machinery, actually, we saw that the national income does what? Considers investment in new capital, new investment, new machinery, new equipment. So we know that the equipment does what? All the machines, they do depreciate, isn't it?
Depreciate.
Yes. And they have taught you in your accounting how to do what? To calculate the depreciation, isn't it? Have you done some accounting? Yes?
Yeah.
And they've taught you how to calculate depreciation. But I know you, if you've not studied, you will study. Yeah. So for example, the machinery, we know that if the country invests in machinery, the machinery does what? Depreciates. So the depreciation will be basically on those items that the country has invested in, but which do what? Which do depreciate, like machinery. Are we together? So that's how we get the net national product to be the gross national product value minus the depreciation, but the depreciation will be subtracted from the investment. For example, investment in machinery, because we know that the machinery does depreciate, the way what we call wear and tear on the existing capital stock. Then let's look at disposable personal income and personal saving. Disposable personal income and personal saving. The personal savings rate will be that proportion, that percentage of your income. Disposable income will be income after subtracting taxes. Yeah. So from that income after subtracting taxes, what you save, the proportion, what percentage do you save? That is the personal savings rate. Are we together? Of course, if the personal savings rate is low, it means the households are overspending. If you are overspending, then it means your savings rate will be low. And if your personal savings rate will be low. And if you are, of course, you don't overspend, definitely your personal savings rate will be high. So let's look at nominal value versus real GDP. Yeah. So with the nominal value, we are basically looking at GDP, yeah, as actual market prices of goods that are sold. Yeah. monetary value, but at market prices. Are we together? For all those goods, the machinery, yeah, all the goods sold, the clothes and so on, we are looking at them. Nominal means monetary, yeah. So we are looking at all those final goods and services at market price. That's where that's what we mean by nominal value or nominal GDP. Then when we talk about real GDP, we are basically looking at adjusted GDP figures at the average prices between years. We are looking at the GDP figures at average prices that have been calculated between years, right? And then when we talk about constant dollars, we are basically talking about dollars expressed in terms of the real purchasing power. Now, the real purchasing power is the real purchasing power would not be basically in monetary terms. Yeah, it's not in monetary terms. Are we together? For example, with the real purchasing power can be that, for example, the ability, it could be that maybe it could come up that maybe the prices have reduced, and because the prices have reduced, people can buy more of the goods and services, more quantities of the goods and services. So that's what we mean by the real purchasing power. It will basically not be in monetary value. Then real GDP is calculated by getting nominal GDP. What's nominal GDP? We've seen that it is GDP at market prices divided by the price level times 100. That's how we get the real GDP. Now, let us look at the importance of national income accounts. The importance. Why do we take all this national income accounting, right? So national income accounts help us in analyzing and evaluating the short-run performance of an economy, right? When you're looking at the economic performance of an economy, you basically look at the GDP figures. Of course, when you're comparing, for example, countries, yeah, countries' economies, you look at their GDP figures, nothing else. They'll look at their GDP figures, and of course, the higher the GDP figure, the more the country has more economic growth than another country. So the economic growth of countries is measured by comparing GDP figures or national income figures, right? So these national income accounts also or figures indicate the level of economic activity and economic development as well as aggregate demand for goods and services of a country. Now, let me talk about the difference between economic growth and economic development. Have you got to know the difference between the two? Economic growth and economic development. Is there any difference? Yes?
I think there is.
Yes. What is that difference?
Yeah, I've forgotten these things.
Yes?
Forgotten these things, but I think economic
Yes?
economic growth could be in the
Could be the what?
with the total shift increase or usually it is an increase in the total GDP of an economy or a country.
And the economic development.
That one, the economic development, what it can be doing with investments and incomes, change in investments and incomes of an economy. That's my view.
That's your view. Okay, basically with the economic development, economic growth, we have seen that economic growth is measured by GDP figures, isn't it? By national income figures, isn't it? Yes. For example, they will give you a GDP figure for Uganda for this year. It is this much dollars. Yeah, that is economic growth. But of course, it will be in terms of different years. You'll be looking at a series of years. For example, if it was this year, it was this much. The other year, it was this much. And then you see how, like, the percentage by which it's growing. Are you getting it? Like, how is your economic, like, it's growing by this percent for this maybe number of years. Of course, you're comparing the GDP figures. Are we together? That is economic growth. And then economic development, economic growth is a subset of economic development. Economic development is broader than economic growth. Yeah. Economic development. For which it will consider the GDP. It will consider actually economic growth, which is measured in terms of the GDP. Are we getting it? And then it will consider the welfare. It will consider the welfare of the citizens. The welfare of the country's citizens. And this welfare will be in terms of, for example, access to health services. Yeah. Access to health services. Access to health services, the life expectancy, life expectancy, the literacy levels, literacy levels, generally the well-being of the citizens, literacy level. Because it is one thing to brag, for a country to brag that you have these huge economic growth figures in terms of GDP, you know, our GDP is growing by this much, by this percentage, our growth is like this, you know, by this percentage. But when at the end of the day, the people are not maybe benefiting from that amount of money, the GDP figures, you find people are poor, you find people do not have access to health services. Are we together? The roads are poor, they don't have access to, they are not studying. Yeah, the people are illiterate, and then the life expectancy is low. So all those economic development will look at all those. It will take the economic growth. Economic development will consider economic growth in terms of the GDP values for the country, but then also it looks at the welfare, the well-being of the country's citizens. Are we together? So it's good. It's possible for a country to have huge GDP figures, but when the people are still poor, people are suffering, they don't have access to health services, there is no medicine in the hospitals. So economic growth will consider all those. I mean economic development, whereas economic growth just stops on the GDP figures. So that is the difference. Then the distribution pattern of national income determines the pattern of demand for goods and services. Of course, the higher the national income means that there is the higher the demand for the goods and services. And of course, here we shall be able to forecast the demand for certain products. Yeah. So also economic welfare depends on the distribution of this national income, where we look at for example, the size of the GDP per capita, yeah, what you call the per capita income, The per capita income would be the GDP over the total GDP value, right? Total GDP value divided by the population, yeah? Divided by the population. For example, you'll get the total GDP maybe for this year, right? Well, maybe was this much for Uganda. And then you divide by the Ugandan population, maybe 40 million. So that one basically gives you the what you call the GDP per capita, or the per capita income, which literally means that when you get that value, it will be the average value that each Ugandan is supposed to be having. Are we getting it? So it helps us to determine the GDP per capita, which basically also helps us to determine the magnitude of economic warfare. But of course, these figures are not, they are not, what should I say? Sometimes you calculate and it's telling you that each Ugandan maybe should have 100,000. It's giving you a GDP per capita of 100,000 per Ugandan. But it's like saying, it's like getting all the marks. Maybe we have 5 students. One got 90. One got maybe 90. Another one got maybe 10%. Are we together? Maybe there are 2 students in a class. And then you say, let me get the average. The average will be what? 100 divided by 2, isn't it? Yeah? 100 divided by 2. And then you say that the average mark was what? Was 50. Is that realistic? Would that be realistic? Because one student got 90 and another one got 10. And then you're calculating the average score and you're saying 50 is the average score, but in some cases it may not be. So that's why we say that economic
50 could be a pass mark.
No. You know what you call average?
Average is sum of.
Yes, I know the mathematics, the formula and what, but when I say average, for example, when I say average salary, I can get the salary of all employees in an organization. I divide by the number of employees. Then I say that average is like I'm getting the relative value that on average, everyone should be getting a salary of this. I don't know if you get me. But in this particular example, which I've given, the average will not work. Because here it's like you're saying every student, if every student got 50 plus 50, then we shall get 100, which is not realistic. So even the GDP per capita may not be realistic, especially when we are only looking at what? The GDP figures are not looking at the welfare of the citizens. So that's why economic development is broader, and for it looks at all those other aspects, right? So also the estimates of national income show composition and structure of national income in terms of different sectors of the economy, right? So different sectors of the economy, we've seen that these 3 different approaches, they are appropriate to those different sectors of the economy that we saw. For example, you could look at the agriculture. We saw that the product approach is useful in agricultural sector, in the industrial sector. So if we use the product approach, it will help us to see how these sectors are faring. Are we together? How these sectors of the economy are faring. So you could find that, for example, if the government has invested in these sectors, it has invested maybe in the agricultural sector, industrial sector, right? So here it will know the performance of these sectors. Of course, by looking at these values, right? By the national income values, it will know that now this sector is progressing like this, how well each sector is performing. Are we together? And then there it will give it, it will be able to plan. Of course, when you see that this sector is faring well, you continue to invest in that sector. Maybe this sector is not faring well, then of course at the end of the day, it guides you on where to, it guides the government on where to invest. what we call sectoral shifts in an economy over time. So we have seen that also this one will guide us, will guide the government in terms of making policies. Yeah. For example, you see one sector is not performing well, and of course you get to know, the government will get to know on how well to invest in that sector and to help it. Yeah. And to come it also helps the national income statistics helps governments to evaluate their economic policies. Like we've already seen that if the government, for example, was investing maybe in the agricultural sector, and after the national income accounts have been taken, it realizes that maybe the agricultural sector is not performing well, then it will know that the agricultural sector is not a successful venture to invest in, right? And of course, it will invest in what sector is successful, of course, depending on the national, as guided by the national income accounts. Then the national income accounts also help us to know, to determine the level of income distribution, yeah, or the level of income inequality. For example, you may realize that maybe it's in the private sector is faring more than maybe the government workers, like we've seen compensation of employees, and then we saw rental income, we saw corporate profit. So those figures will guide us that now maybe it's the private sector that is faring well in terms of income distribution, and maybe the government workers are not faring well. So at the end of the day, the government may be even forced to do what? To increase salaries of these civil workers. Because of the figures, because of the statistics will be able to guide the government to eliminate the income inequalities. Of course, these income inequalities can be eliminated by using, for example, taxation, whereby the rich, for example, the rich can be overtaxed more than the poor. In terms of sectors, of course, in this perspective, to eliminate or to reduce the income inequality. All right. So also these national income accounts also help us to determine the standard of living, right? The living standards of these different sectors, and also it will determine the sectors that are eligible for loans and other funds. Of course, after looking at these figures, you will know which sector is not faring well, and maybe the government needs to invest in it, right? And then also the national income data also guides the government in terms of making policies for growth and inflation. Of course, this inflation will be reflected in the prices, where you see that maybe the prices are high, the prices for certain products are high, then of course there you'll be able to measure, the government will be able to measure the inflation rate. Of course, the inflation rate is measured by the consumer price index. You basically look at these prices, and it will let you know which sectors are experiencing inflation, and of course be able to regulate that inflation. So these figures are useful. They're even used for research. Yeah, researchers use these figures to carry out their research. Now, what are the limitations of national income accounting? It has limitations, right? The fact that it only considers the monetary value of all final goods and services, it literally means that it excludes the non-market production, right? Because they are goods that are produced but not specifically for the market. They are produced for personal consumption. So what happens to those non-market goods and services? So that is a limitation. Then GDP figures or national income figures may not necessarily be a good measure of the well-being of a nation. Like we've already seen the difference between economic growth and economic development. That much as that economic development, for it considers that economic growth is a subset of economic development. So GDP figures only are used to economic GDP is a measure of economic growth. But again, it is not a measure of the well-being. It is one thing to have huge figures as a nation, huge GDP figures or national income figures, but when the people are not having a good standard of living, when their welfare is not good, like we've already seen that economic development will go beyond the GDP figures. It will consider the GDP figures, but also go beyond, look at the life expectancy, look at the literacy levels, look at the access to health services and all those, right? So GDP is just, it is a narrow way of looking at the well-being of a nation. Yes, and then also, it's not a measure of a nation, a nation's overall warfare. We've seen that. And then GDP is a measure of the value of production in terms of market prices and an indicator of economic activity. So it only considers the economic activity, but it ignores it. Of course, it looks at market prices, but how about those other goods that are not on the market? So it eliminates the non-monetary value. It does not consider the non-monetary value of goods and services, right? Then the GDP accounting rules do not adjust for production that pollutes the environment, right? So for example, we saw, I don't know if you've attended my microeconomics classes, but we looked at negative externalities, right? And we saw that, for example, pollution is a negative externality of production, right? And we saw that a negative externality is a cost of market transaction that is not reflected in the price of a commodity, but it basically happens to a third person. Yeah. And we saw that, for example, these factories, yeah, for example, coal mining factories, all those manufacturing factories that emit what we call greenhouse gas emissions like carbon dioxide into the atmosphere, that pollution has to be, we saw that it has to be accounted for. When these factories do not account for the pollution, then we saw that it becomes a market failure. And we saw that the government comes in to control the market failure by attaching a price in form of taxation, right? But now with the GDP figures, they're simply looking at the monetary value of all final goods and services, but produced in the country, but they are not looking at all these other external costs, all these other externalities, for example, of production, negative externalities of production, like pollution, right? And then the GDP has nothing to say about the distribution of output. Of course, it will only look at the figures. Yes, Uganda has this much GDP dollars, this much dollars of GDP, yes. But at the end of the day, how is that money distributed among the citizens? Apart from calculating the GDP per capita, where we are getting the total GDP value divided by the total population, and then we say that every Ugandan has to get this. Is it really the realistic element of it? Or we are just calculating figures? Are we together? So for it, it will not, it doesn't really, it doesn't consider the redistribution income policies. And then It is also neutral to kinds of goods and that an economy produces. So you may find that an economy maybe is, what if an economy is only producing maybe manufactured goods? Yeah. So for it just looks at the general term, final value of goods and services. But now, what kind of goods and services? Is it looking at manufactured goods? Is it looking at consumer goods? Are we together? So it does not consider what kind of goods. It is not specific in what kind of goods are produced. Then per capita GDP, per capita GNP, right? Anything per capita, you have to divide, yeah, by the population. So when we say GDP per capita or per capita GDP, you shall get the total value of GDP divided by the population of that country. Then GNP, we already know what GNP is. Shall get the total value of the gross national product divided by the population of that country, right? So the per capita GDP is a better measure of the well-being of the average person and its total GDP or GNP. So it helps us to know, for example, how much money does each Ugandan, should each Ugandan have, right? Then underground economy. What is underground economy? It is that kind of economy where the transactions are not reported to the government, yeah? So of course we know that there are issues of smuggling, where people smuggle, and those transactions are never recorded. They are never known by the government. So that's what you call the underground economy, those unreported transactions, and of course to the government, and of course they will not be included in the national income figures. Now those were the limitations. Now let's look at the problems of limitations. A limitation is something that does not allow, that prevents you from getting like the actual. Yeah, it limits you from being where you're supposed to be, from the ideal. And then a problem. What are the problems of national income? Number one is double counting. Double counting. This GDP national accounting, the national accounting activity, it has a problem of that. For example, there is a problem of identifying the closing stock and the opening stock. That is a problem. Yes. For example, if you're looking at maybe you're looking at a factory, yeah, a manufacturing factory, maybe it's a steel, it's called a steel what? Steel manufacturing factory, right? And maybe it's manufacturing iron sheets. Now, how will you know that some of those iron sheets, when you're taking the national income accounting for this year, let me say 2021, how will you know that some of those iron sheets manufactured by that company or by that factory were from last year? How will you know if this factory has not disclosed it to you? How will you know? Because you find that some of the goods they were manufactured last year, but they are still in stock. They are together with the same stock that has been manufactured this year. So how are you going to know that this stock is for 2021? Part of the other stock was for 2020. So at the end of the day, we are going to have a problem of double counting, because not all businesses are going not all businesses are going to expose their information about opening stock and closing stock. So that is a problem in the national income accounting. Then also there is a problem of non-monetary output, yeah, where we see that there are those activities that are not priced For example, the work of housewives, yeah, the work of housewives is not monetized. Those people that produce goods and services for subsistence purposes, that one is also not monetized. So the element of just depending on the final value of monetary value and goods and services does not really bring out the clear picture, right? And then we have definition problems of household. What a household is, what transfer payments are, yeah. So those are some of the problems of national income accounting. Then also lack of information, right? Lack of information, especially for that underground economy that we have seen, where we have activities like smuggling, yeah, gambling, those ones that are not really exposed to the economy, right? So that's what we call the underground economy, where there is smuggling, there is gambling. Some of those private expenditures are not exposed. Yeah, you cannot know. So that information will not be known, and therefore it will not be included in the national income accounts. Then there is a problem of timing of production, and this is due to the overlapping season. So it can so happen that the national income accounts are taken in a period where maybe, of course, as businesses, there will be those seasons where the business will be those seasons where businessmen, for example, they make profit. They are expected to make profit, and then there are also those seasons, those months where they say no. Maybe this season our children are going back to school and we don't have money. So it can happen that the national accounts are taken in a period where maybe the businessmen, maybe the business is booming in that kind of season. So you may end up getting high figures, high GDP figures, and at the end of the day, you conclude that, the economy is faring well in terms of GDP figures or economic growth. But when the problem is with the timing when you took those national accounts is misguiding you in terms of the figures that you came up with. So there is that problem. Then there is another problem of inflation, yeah, where we see that inflation is the persistent increase in the general price levels in an economy, right? So if there is inflation, for example, in an economy at the moment when the national income accounts are being taken, there is a tendency of the inflation to bring about huge figures, and then these huge figures will actually misguide you or misguide the economy, that the economy is faring well, but when it is the inflation actually that is making those prices to be high, and finally misguide in terms of the values, which may also misguide that the economy is faring well economically, right? And then lack of facilities, that is a problem. Which facilities? When the national income accounts are being carried out, computers are needed, right, to collect this data, to analyze it. So of course, national income, you're carrying out all these, you're carrying this data, you're collecting all this data around the country. So you require a number of computers, for example, to collect this data. So sometimes, especially in these developing countries of ours, you may find that those facilities might not be enough. And because of that, you may end up not getting accurate figures. Accessibility to some areas due to poor road network. So there are areas you go to, of course, to collect these national income figures, and those areas are not accessible. The road network is poor. You find maybe it is a flooded area where you cannot cross over. Yeah. So all those challenges Of course, at the end of the day, such inaccessible areas, these people that are collecting this data might not be able to even reach those areas to collect the required data that should be used in the national while calculating the national income accounts. Then we have there is a problem of political instability or insecurity, right? So in periods when a nation is experiencing political instability, gunshots everywhere, people running left, right, and center, in those periods or in those kind of seasons, the national income accounting may actually not take place. It will not take place. You cannot begin taking these national income accounts when bullets are all over the place, right? So for those periods, you'll find that we have blank figures. In terms of data, it is blank. We don't have the data in maybe those years when there was political instability. So that is a challenge. So literally, political stability has a lot to do with determining, of course, how well these national income figures are taken. Yeah, because you cannot move that, we are going to get data from these businesses, from these sectors, when there are gunshots everywhere, there is insecurity. So even political stability is useful for the success of this activity of national income accounting. Then another problem is lack of qualified personnel to collect the data and analyze it. So of course, these people that are collecting the data have to be qualified. Otherwise, if they are not fully qualified, we may end up getting wrong data, because we need people that are knowledgeable in that area, that know what they are doing. So of course it requires spending. Yeah, it comes with a cost. You have to get qualified personnel, but in most cases you may find that they are not enough. Right, so let's look at the determinants of saving. The determinants of saving. Saving depends on the dependence rates, right? Dependence rates reduce saving. For example, when you have very many, should I say, relatives that are depending on you, you're taking care of them, you're running the home. There are many maybe dependents, orphans that you're looking after. Of course, at the end of the day, the spending will be a lot, and the saving will also be less. Yeah. So of course, when you don't have many dependents, your income will be, your savings rate, your expenditure will be low, and therefore your savings rate higher. Then level of education, both formal and informal. Of course, educated people are taught, they are taught on how to spend, so they know the goodness of saving than the informal people, the illiterate people that are not educated, that do not know the importance of saving. And then the pattern of consumption. Of course, the higher the level of consumption, the lower the level of saving. And the lower the level of consumption, the higher the level of saving. Then tastes and preferences. Yeah, you may find that your tastes as an individual for, these luxurious things, clothes and so on, is low. So at the end of the day, you will not be extravagant, you will save, contrary to a person who, when they see this, they want to buy it. When they see a new shoe, they want to buy it, even if it's not relevant. Yeah. Then the income of an individual, we are looking at the determinants of saving. Also, the income of an individual determines the level of that person's saving. Of course, the higher the income, keeping other factors constant, the higher the level of saving. Then the interest rates, right? So of course, we are looking at, for example, interest rates in terms of when you save your money in the bank. It can be when you save your money in the bank and that money gains interest on it. Yeah. So when you save your money in the bank and there is high interest that you're gaining on that money, of course, your savings rate will increase. Then inflation definitely discourages saving, because with inflation, we know that inflation is by definition is the persistent increase in the general price levels in an economy, right? So of course, this persistent increase in the general price levels of an economy comes about with increase in money supply, which increase in money supply increases the aggregate demand for goods and services. And of course, increase in aggregate demand for goods and services increases spending and therefore reduces savings. So that's how inflation reduces savings. Then taxation, of course, the higher the taxes imposed on goods and services, on businesses, it will reduce, it will reduce the level of disposable income. Just imagine maybe the corporate tax has been increased, the tax that they are taxing your salary, your business is high. Then of course, at the end of the day, your disposable income will reduce. Disposable income, we've seen that it is income after reducing, after subtracting the taxes, right? So your disposable income reduces, and therefore your savings, right? So I want us to stop here for this session. See you next week.